Guys, my name is Tyler. I'm one of the financial advisors in Canada, specifically in Ontario. I work for Precision Insurance. We're partners with Industrial Alliance. You guys might have heard for that company. It's a very big company in Canada, and we're also in the United States. I wanted to make a video about the investments in general and how they work, and actually how you can make money using dividends. So I've been in this industry for about 6.5 years. So I was here with Industrial Alliance for quite some time, and I really wanted to share my knowledge with the world. I've been having a lot of great clients that I've met throughout my career, so I really wanted to share my knowledge and kind of broaden it out and kind of get to you guys around the world to really help you. I know finance is a little bit complex sometimes, so I just really want to share my knowledge and make a big difference in this world. So without further ado, let's get into it. I had a presentation set up for you guys. So investments in general are actually very important, guys, because basically how it works is that you're giving companies money which they use to fund their operations, right? Once those companies have that money, if they expand their operations and they make more money, that's how you make more money. Now, why is that very important to invest when you're younger? When you're above legal age and you're allowed to actually invest, it's because the rate of return over time, let's say it is going up every year, is that you'll be able to build your wealth faster as opposed to starting it later on. It's the rate of return would start the time that you actually start investing. So somebody, for example, who's 18 versus 25 already has 7 years of rate of return, given it is a positive rate of return over those 7 years. Okay, so let's give an example here. Global Dividend Dynamic. This is one of the funds that we offer here at Industrial Alliance. Dividends are basically equity securities that generate or will eventually generate regular dividends, which will be reinvested in the fund. Basically, how dividends work, guys. Let's go into what dividends are. What are dividends, right? Just so I can reference what I'm saying. So dividends is a sum of money paid regularly, typically quartered by a company to its shareholders out of its profits or reserves. So what that basically means is that companies will have a lot of money usually when they're doing their operations. They don't really know what to do with it. So people who invest in their companies, they actually give something called a dividend. It's basically like a cash reward where the companies give you money every quarter. It can even be monthly, semi-annually, depending on how the company structures it. This is very important because not only do you make money through the price appreciation, like buying low and selling high, but you also get paid from your investments quarterly, monthly, or semi-annually. And especially if the companies that you're investing is very stable, you'd be able to get a rate of return on a consistent basis, which is very important for your portfolio because you want to be able to build up as much wealth and you want to have a positive rate of return as you go on in your working years. I have an example here that I'd like to show you just generally about investments here. So let's say, for example, you put in $5,000. TFSA is like a tax-free investment account in Canada for all you Canadians out there. Hi. So let's say you put in $5,000. You're contributing $100 a month for, let's say you're 25 years old and you're contributing for 40 years up to age 65. The rate of return is 8%. So if you start very early, you can see that at the end of 40 years, 8%, give or take. It could be higher, lower, every year changes, but just for a forecasted amount, you'd be able to have 432,802. Part of this 8% obviously is dividends. This can be higher or more, depending on how the companies are performing. But as you can see, from a general perspective, investments are very important because you're building your wealth at a very early age, and you're able to generate that interest rate, a positive rate of return, every month or every day. It does go up and down, but if you do start earlier, you can see your wealth is just tripling or doubling every single year. So that's very important, and implementing dividends as well, because dividends it's part of a strategy to actually build your wealth by collecting dividends every quarter or whatever it may be. Okay, I also wanted to go over global dividends. This is actually very important to know, is that when you're investing in dividends, it's very important that you invest in other countries. Why? For example, I'm in Canada. Let's say, for example, I invest in dividends in dividend funds in America. Because our dollar is lower than the United States dollar, all the profits that come from the States is actually more by about 25 cents. So for every dollar that I get in profits, I would get a 25% markup on top, which is pretty good because if you factor in the exchange rates, it's you can actually get more bang for your buck. So that's how dividends work. Basically, this is the rate of return throughout the past years. Obviously, historical returns isn't a guarantee for or it should be an indicator for the future, but it isn't like exactly a total like guarantee that this will happen this year because this happened. It's just it changes over time depending on the companies that you're investing in. Okay, then I wanted to go over something with you here. As you can see here, this is this is the fund that I put in for some of my clients. As you can see, for the historical returns, you can see the net compounded returns 9%, 18%, 15%, 15.4%, and 9.97%. So you can see that these rate of returns are pretty high, and if you really take into consideration dividends as part of the portfolio, you're making money through the price appreciation, which is when you're buying the asset at a lower price and obviously selling at a higher price, or just holding it, whatever you want to do, like holding your investment, not cashing out. But you can see that this is very important because this is including this includes dividends, right? And this is also important too. I said about the countries that you're investing is also important because you get paid on the exchange rate. Putting these into different countries, you'd be able to take advantage of the fluctuations in the exchange rate. And this is the allocation. So let's say you put 5,000, 26.9% would go towards, of the 5,000 will go here, etc., etc., etc. So you can see if you put in if you put in $10,000 in 2009, it would have been, in 10 years would have been 25,000, so it's about 15,875 in 10 years. So you can see the power of compounding your money, and this rate of return includes dividends. I'm going to go into a little bit more detail that I've expanded what I'm saying here. So capital appreciation, guys, is basically when you're buying low and obviously selling high, or just holding, whatever you want to do. So a part of this growth was because of capital appreciation. 13.9% specifically contributed to the actual rate of return. But if you can see here, a part of the rate of return also included dividends, which is very important too, because if you add this plus this, you're making 13, 14, 15, 16, but 17, about 18%, give or take, and whatever the decimal, you get what I mean, right? 18%, and then if you can see here, the dividends also contributed to these years, or these decades here as well. So not only do you make money through the capital appreciation, but you also make money through dividends. Now, a lot of people actually have money in savings accounts or checking accounts or money markets, or like very low interest rate environments. But having this kind of portfolio in your investment portfolio is pretty good, because you'd be able to take advantage of two kind of ways to make money, as opposed to just capital appreciation, or just a simple savings account where the bank just gives you pennies on the dollar. So it's also part of it's a good strategy long term. As you can see here, the portfolio manager is David Fingold. So obviously these funds are not created by me. If that was me, that would be great. But these people have 30 years. This guy has over 30 years of experience, and he has his experiences all here, all his designations, whatever. So you can see here that he's a very well-known individual. So he does manage the fund actively, and he's the one in charge of actively managing the fund and doing the allocation of where the money should be going. So he does the research on this fund on a daily basis, and he's able to kind of see where is the best place to put your money. If you can see here, why should you consider this fund? Because it's regular dividends, and it also ensures long-term growth. And dividends obviously have contributed over 40% to the S&P 500 index total over a 90-year period. So you can see that dividends play a huge role, 40%, into the total return over a 90-year period. Now, can you imagine if you had this, if you were invested in dividends over the long term, and you were able to get something like this kind of 40% of the return actually came from dividends if you were in the long term? You could imagine by now, if you had it for at least 10 to 20 or even 40 years, if you were alive back then, you would have had a lot of money there. A lot of money now, as opposed to, some people, they have just money in a savings account or a checking account for so many years, and they don't even know that the opportunity cost, or what they're investing in, is they're not making money over how many years, and as a direct result, they're actually losing money indirectly because of inflation, and other factors, right? So speaking of inflation, hope I'm not going too fast, but that's also a part of the presentation that I'd like to go over too, is that for example, inflation is basically the cost of living is going up because the government prints money. It's called quantitative easing, where the government prints money. As a direct result, inflation goes up because there's more money supply in the economy. But just to make it simple, inflation is basically when the cost of living is going up year after year after year. So by leaving money in a checking account where it's earning nothing, you're indirectly you're losing money by the depreciation, or the value of your money is actually going down as a direct result of inflation. So for example, let's say we're in 2019, and in 4 years, at 3% per year, so that's 4 years inflation. The value of your $10,000 would be $1,255 less. So what does that mean, Tyler? It basically means that for the $10,000 that you have here, if you were to spend goods and services or whatever you spend money on, you would have to spend an extra $1,255.09 more from the $10,000 that you were saving up. So your money is actually being deflated, or it's depreciating over time. So it's very important that you have investments that generate well and above 3%. Specifically, if you can put in dividends, that would be great, and other kinds of investments. But if your investments are not making more than 3%, then you're pretty much losing money. You may think that, oh yeah, I'm saving a lot of money, I'm putting all my money in the piggy bank, but that's actually counterintuitive, because that money that you're putting either your checking account or your piggy bank is not making any money. As a direct result, you're actually losing money instead of making money. You think you're saving money, but the value of your money is going down, if that makes sense. So that's pretty much it that I had for the presentation today, guys. But this is my first YouTube video, so hope you guys take it lightly on me. But I just wanted to give you an example of the importance of financial planning. This is the first of many topics that I'll be talking about. I'm going to be going over a lot of things as I go on in my making these YouTube videos for you guys. But I'd love to know what you guys think about this information. If you found this helpful, if this really benefited you guys, and if you can share this with all your friends and family, I hope that they'd find value in this too. So if you have any questions or concerns, please, I'd love to hear from you guys. Comment down below, like, share, subscribe, all that stuff. None of this is financial advice. I have to disclose that to you guys. Dividends and generally investments. This is none of this. These kind of funds. If you are in Canada, it's not financial advice. This is just for entertainment purposes only. So if you do want to invest in some securities or equities, or please consult with a financial advisor, myself, if you are here in Canada, specifically Ontario. So that's it for today, guys. I will be posting more videos. Just let me know what you guys think. Put some recommendations that you some kind of topics that you'd like me to talk about, and I'd love to make a video for you guys in that manner. So I'll see you guys later, and I'll see you on the other side, or the other video. Thank you. Have a nice day. Bye.